Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, January 12th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is more mixed signals in U.S. inflation data and China's structural oversupply and demand deficiencies persist. The nuance there is the past 24 hours have delivered investors more mixed signals in U.S. inflation data, as well as data that indicates China's structural oversupply and demand deficiencies persist. The good news on the U.S. inflation front is that both the December and CPI and PPI data indicate immaculate disinflation persists. The bad news is that only the PPI report indicates immaculate disinflation is likely to continue persisting over the medium term. Conversely, the CPI report continued to demonstrate emergent signs of sticky inflation. With respect to China, Beijing has not yet done enough to offset structural oversupply and demand deficiencies on the mainland. From a market implication standpoint, the risk of either a no landing or hard landing have not gone away, and we believe those probabilities will begin to rise again at some point in 2024 and perpetuate a phase transition to a risk-off top-down market regime, which would be inflation or deflation in the process. Yesterday, we communicated that neither our quantitative risk management signals nor qualitative research indicated that a RORO phase transition was imminent. RORO just stands for risk on to risk off, or risk off to risk on, depending on where you're coming from. Adverse developments in our macro weather model composite signals now indicate a much higher probability of a RORO phase transition in the short to medium term, which is 1 to 3 months. Those macro weather model developments have bearish implications for our KISS portfolio construction process as well. And we just published an update to our KISS portfolio construction process vis-a-vis our Around the Horn publication. So for those of you who are Around the Horn subscribers, you're getting that update. Please make those changes in real time. In terms of transitioning to our macro scouting report, not macro scouting report, transitioning to our macro 42 macro dashboard, we'll start with our signals, trading range signals from our friends over at Longbow. We're getting an oversold signal in the 2-year nominal treasury yield, so that's something to be of note. And then transitioning to our 42 macro aware community. Again, the question from a subscriber title, very odd SOFR behavior. With a mildly hotter CPI, we increased the probability of a hike in March, and the short end dropped like a rock. Short end of the treasury curve, i.e. 2-year treasury yields. That's why they're oversold this morning. Is there something under the surface of the data that they're missing? Talked to a lot of people. Everyone seems to be baffled by the price action. If PPI comes in lower, we might print a new cyclical low on 2s, and that's exactly what we are seeing this morning, a new cyclical low on 2s. So one thing I'd say on all this is that a couple things I'll say, and I can go on a long diatribe about this, but I got to hop for a meeting, so I'm going to keep it brief. The first thing I'll say is that bean counting things like SOFR and all this kind of stuff, all this jazz, is not going to help you achieve your strategic investment objectives. Your goal as an investor, particularly if you're a retail investor, should be to maximize upside capture in bull markets, and it should be to minimize downside capture in bear markets. It should not be trying to bean count monetary plumbing so you can sound smart on Twitter and on forums. Leave that to folks like myself who understand these dynamics very at a high level, that can actually pull the information that is relevant for actually maximizing upside capture in bull markets and minimizing downside capture in bear markets. Remember, your goal is not to sound smart bean counting monetary plumbing like most people on Twitter. Your goal is to make money in financial markets and save money in bear markets. That's period, point blank. So let us trust our process, trust that things like the macro weather model, the global macro risk matrix, qualitative research process, which I think is among the best in the world, just help you land the plane safely in this bull market run that we accurately called for back on November 1st. So that's all I'll say on this particular thing. And just one final thing I'll say for those of you who insist on bean counting monetary plumbing dynamics because it makes you feel good. I don't know if it helps you make any money or not, but it makes you feel good. If you want to bean count those things, just understand that the 2-year nominal treasury yield is a completely different market with a not necessarily completely different, unique or discrete set of market participants, but certainly different market participants than the SOFR market. And more importantly, the SOFR market has different tenors. So if you see SOFR for March 2024 rising in terms of the probability of a rate hike, that is very different than the entire sort of SOFR probabilities implied by the 2-year nominal treasury yield out 2 years. And so you can't just say, well, March went up in 2024, but the entire 2-year curve, you have to understand what's happening in the entire 2-year curve. So what ultimately that means is that a higher inflation print is telling investors that we're pricing in too many rate cuts over the near term. And if we're pricing out those rate cuts over the near term, it probably means that the monetary easing, the easing of financial conditions that we've recently experienced in the US economy is going to start to move in the wrong way, which ultimately increases the probability of a hard landing later down the road, which is why the 2-year can decline. So hopefully that is a good explanation for that very specific question. But to me, the broader takeaway is to stop counting these monetary plumbing dynamics, because for by and large, they're not helping anybody make and save money in financial markets. I think we do a good job of pulling out the data that we need to from a liquidity perspective and ignoring all the nonsense that we don't need to for our clients here at 42 Macro. So we're wrapping up there. Darius Dale presenting our Macro Minute for Friday, January 12th, 2024. Best of luck out there today. We'll catch you back here tomorrow. Cheers.